All right, thanks everyone for joining to Hacking Your Round. We're going to talk about how to raise capital. So very briefly, my name is Nathan. I run a startup called Founder Suite. If you haven't checked it out, it's a platform for startups that are raising capital. So we have an investor CRM, an investor updater tool, investor database, and a collection of docs. We're about 2.5 years old as a startup. We're a startup. We launched this product in March of 2016, and since then our users have raised over $250 million, which is pretty exciting. But before that, I spent about 10 plus years as fractional CFO at different startups, almost always helping them raise money. And about half the time we were able to raise money, and about half the time we put in the old college try and not be able to raise money. So I kind of learned the good, bad, and ugly of fundraising. Hopefully I can share some good tips with you. First off is how not to do it. Hunter Walk is a VC here in San Francisco at a seed fund, and I love this tweet. Will you introduce me to investors? It's too broad to be acted upon. This is how a lot of founders approach fundraising. They just start asking everyone they know, hey, do you know some VCs I can talk to? And the problem with that approach is it's unfocused. It's too ambiguous, as Hunter mentions, and it's also putting that work of figuring out who you should be approaching on the shoulders of the other person, where really that is your job as startup CEO to figure out who you should be chasing, who you should be pitching. And, you know, I mentioned I spent 10 years consulting the startups. A client would hire me on to largely do that work, and I would often spend 40 to sometimes up to 100 hours researching investors, building the target list. It's getting a lot easier with databases we have today, but, you know, it's a lot of work to figure out who to reach. So instead of approaching it like this ambiguous, you know, casual approach, I like to frame it like the sales process. If you've ever been in sales, sales is pretty structured, right? You build a list of leads, you qualify those leads, you engage with those leads, and ultimately you're driving everyone towards a close, right? Sales is pretty structured. And the funnel metaphor really applies both to sales and to fundraising. So kind of expanding on what I just talked about, right? Step number one is building this large potential list of investors, or list of potential investors, and then screening that list, filtering that list by geography, stage, et cetera, then figuring out who to reach, especially if you're approaching venture funds. You don't just go pitch a venture fund. You typically need to find a partner, decision maker, someone who can champion your deal at that fund. Then we're figuring out how to reach everyone on this list, right? And it's all about the warm introductions. We're going to cover this in greater detail. Then, of course, those introductions are leading to pitch meetings. We're presenting our pitch deck, our model, our vision, everything else. Hopefully that's leading to more meetings. You get into due diligence. If you're not familiar with what due diligence means, it's a deep dive into your business. When we were raising money, you know, we got a term sheet from an investor. Then about 2 days later, they sent us a list of 120 different items they needed for due diligence, everything from like articles of incorporation to customer references to, you know, market size, stuff like that. And then ultimately, you're selling shares of your company. Right, so fundraising is just a very important sales process. And if we think about the funnel, you know, it makes it a lot easier. And I like to frame it, this last point on this, I like to frame it this, especially if you've never done this before, because we can break it into step-by-step process. And that removes a lot of the frustration and chaos that a lot of founders feel when they go out to raise money. So let's get into each step. Step number one is building our funnel. 2 key points here. Fundraising is a numbers game, especially if you're doing angel round, seed round. You've got to talk to a lot of investors. When I raised our seed round, I pitched over 200 investors and ended up with 1 seed fund and 10 angels coming in on the round. So you can do that math. That's roughly a 5% conversion rate. And that's actually pretty typical. That also means that you're getting rejected 95% of the time. And sometimes people who haven't done this before are shocked by how much, how frequently you're getting rejected, right? 95% rejection rate, but that's actually fairly normal unless you have, incredible traction or some other factor. And of course, that level of rejection further emphasizes why you need a large starting list to work through. Let's see. If you're raising a Series A round, these numbers decline a little bit. I typically advise more like 30 to 50 targets in your funnel. And of course, Series B and Series C, that number actually kind of shrinks. The number of potential investors declines. A couple ways to build your funnel. AngelList is, pretty useful. They've got a roughly 24,000 or so investors in there. You can search it. It's free. It's pretty easy to use. Within our product, FounderSuite, we have a database. It's also free to search around in, play around with. What we did is we've got about 50,000 investors in here, and we basically put together this list of both angels and VCs, and then we collected their bios, and then we spent a lot of Mechanical Turk hours collecting everyone's social links. And then we categorized them by market tag and location tag. So you can't freeform search. You've got to kind of guess at what your most relevant market tag would be. Start typing that, select from the list of drop-down options, and then display results. And then most people will spend a few more minutes, so if they find someone interesting, opening up like the LinkedIn page of that person, doing a little more digging into that person, and then if they look good, they add them to their board, which doesn't notify the investor, just creates that list. And again, this is free. Crunchbase is also pretty useful for this task. The way I like to use Crunchbase is I make a list of companies that are similar to mine but not directly competitive. I plug them in, and I see who funded them at my relevant stage, right? Another way you can use Crunchbase is if you have an investor, you can put that investor name in here and see who they co-invest with. So that's kind of useful too. And Crunchbase I think there's a free version. They have a pro plan too, which I haven't explored too much. But a couple other places to build your funnel. Remember, we're trying to build that list of 100 to 200 plus names to work through. PE Hub, Inside Venture, and Venture Pulse are all daily newsletters. These are free. I subscribe to them. I spend 5 minutes every morning with my coffee kind of just skimming these things. And basically, they just are summaries of all the deals that were announced recently, right? So you can go in there and, you might see companies that are kind of similar to yours and see who funded them. They also are places where venture funds themselves announce when they have raised a new round. And that's useful because you ideally want to be pitching firms that have fresh capital, and we'll talk about that a little bit more. So if a venture fund just raised another, $100 million or $50 million round, they're ready to put some money to work. That's always a good thing. Conferences can be useful, especially if you're in a new or emerging space like blockchain or something. A lot of these conferences spring up, and investors love to build their own brand around a new market by getting out there and speaking. Quora, TechCrunch should be pretty obvious. Quora is kind of interesting. People spend a lot of time answering questions like, who are the top 10 investors, who are the top 10 seed investors in Austin, Texas, or something like that. People have probably answered that. PitchBook, Metamark, and CB Insights are all paid databases. They're really good. These guys, especially like PitchBook and CB Insights, have 100 data analysts on staff, really rich data, lots of different searching capability. They're very expensive. I think PitchBook has a startup program that's like $12,000 or $15,000 a year. CB Insights is getting up to like $100,000 a year. I'm not sure what Metamark's pricing is these days. So these are not cheap databases, but they're very good. If you know someone who has access, you can maybe borrow their credentials or something. And then mining your own personal network. This is a really important step in fundraising, is kind of tapping your own network and leveraging that. So let me show you 2 ways to do that. Little demo here. All right, so one way is, of course, LinkedIn. I call this LinkedIn scraping. And what I do here, this is just my own homepage on LinkedIn. I'm on the free version. I will go in and I'll do a search on something like, just keep it simple, angel investor. Okay, so I've got 4,000 results for that, but that's too many. So then what I'll do is narrow it down a little bit. Second degree connections, and let's add a location. Let's do San Francisco. Okay, this is much more meaningful, 518 results. So basically there's 518 people that have the word angel investor in their title that I have a mutual connection to, right? They're second degree connections, so I have someone in between us that I can theoretically ask for an introduction. And then what I'll do is I'll kind of just go right click, open them up in a new tab, and I'll open up 50 or 100 tabs, and I just quickly kind of go through and skim each one, picking out people who look like they could be relevant for what I'm doing, and also trying to figure out who my best connection is to that person. So that's how I kind of scrape my LinkedIn network for this job. Another way to scrape your network is what I call the structured advisor approach. So this is my Founder Suite board. This is what I use to manage my investor funnel. And you notice here I have a column right here called Steve B. Leads. So what I did is I went over to these three dots. I created a column, titled it Steve B. Leads, and then I invited Steve Bennett, who's one of my advisors, into my account. This is all free. And I said, hey, Steve, can you add some people from your Rolodex to my board? And he did. He added 15 or 20 names from his Rolodex, people he knew. And I did this same approach with like 5 or 6 other of my advisors and angels. And, you know, collectively they added about 60 warm leads to my board. So doing this in a nice structured way is pretty effective. Much more effective than if I just said, hey, Steve, can you connect me with some people? I gave him a place to add specific investors. And just to finish this thought, to add Steve to my board, I just go over into settings and team. Okay, so LinkedIn, using LinkedIn, using a structured way to kind of pull people out from your network's Rolodexes. These are all the tools we use to build that target investor list. Talk about that. Okay, now we've got this list of 150, say 200 investors. Now we actually want to start qualifying this list. So back to our sales metaphor, right? Good salespeople don't just pitch everyone who comes through the door. They qualify leads. They spend time prioritizing, ranking leads, removing people from the funnel, and we want to do that with our fundraise. This is really, really important. A couple of reasons why it's so important is it's easy to spend a ton of time chasing down and meeting with people who aren't really relevant investors for you. I've done this mistake so many times in my own life where I've, get some connection to an investor. They agree to have a meeting, so I'll drive an hour and a half down to Menlo Park to meet them. Within 10 minutes, it's clear it's not a good fit. I didn't do my job of qualifying them, and I drive another hour and a half back, and I've just wasted half a day, pitching someone who's not relevant. If you're doing that, if you're fundraising like that, you will never be able to get momentum going around if you're pitching irrelevant leads. So we want to be removing people who've invested in competitors. That should be pretty obvious. If they're an ethical investor, they won't even really talk to you or take your pitch. If they're unethical, they might even send your pitch deck on to the competitor that they funded. No dry powder. This applies to venture funds. If a venture firm has not raised a new fund in the last 2 or 3 years, they're probably only doing follow-on deals in their existing portfolio companies. That's kind of the cycle of how a venture fund works. They might still meet with you, but they're often become tire kickers in the latter days of their fund cycle, right? So again, that's why it's also great to be pitching venture firms that have just raised a new fund. They've got dry powder ready to put to work. Same with angel investors. If you plug an angel investor in and all their deals are from 2014, like you plug them into AngelList and all their deals are 2014, they might be taking a break, not doing a lot of new deals. Wrong sector, wrong stage, wrong geographic location. All this should be pretty obvious, but if you're a fintech company, you wouldn't be pitching a medical devices investor. If you're seed stage, you wouldn't be pitching a $800 million, growth capital fund. Some of those guys will take a meeting with you, which makes it confusing, but they don't typically invest in your stage. They need to be writing bigger checks, so you can waste a lot of time, pitching those people. And then the wrong geographic location. If you look at most venture funds websites or even angel investors, they're usually specific if they have a geographic restriction, right? I was looking at Voyager Capital, and then I look at their website and they're like, we invest in Pacific Northwest startups, and I'm based in San Francisco. So it didn't make sense for me to try and work my way into an introduction there. They don't really do my geographic location. And then finally, bad reputation. This is a little trickier if you're in an accelerator or incubator, or if you're in an entrepreneur's network. It's always great to kind of trade off information about investors. I know Y Combinator has something called Bookface, which is like this private message board where people talk about investors. I think 500 Startups has something similar. There is a site out there called thefunded.com, kind of like a Yelp for investors. There's a newer one called Know Your VC where people are also leaving, comments on investors. So pretty interesting. It's a pretty easy wormhole to fall into. You start reading these reviews. It's kind of entertaining. So bottom line, we want to be removing about 25-30% of our target list, so we have what's remaining is a really well-qualified list. This will help you get momentum going on your round later on. Okay, step number 3, we want to figure out how to reach everyone on our target list. We have this nice list of 150 names. Now we've got to map how to get in front of them. LinkedIn is, our friend here. If you're using Founder Suite, you can just click the LinkedIn icon. That'll open up that investor's page, or you can just, go direct to LinkedIn itself. And you just see if you have any mutual connections to that investor. If you have multiple mutual connections, there's a hierarchy of who to ask for the introduction. First and foremost is someone who's made Tim money in the past. Tim will gladly take that introduction all day long. I had one guy in my kids' preschool group, another dad who sold his company for $640 million. He made a couple introductions for me, and everyone he made an introduction to got back within 5 seconds or less. I'm not even exaggerating. The response time to the introductions he made was incredible. Number 2 on the list, I only had one of those, so those aren't that common. Those are kind of like unicorn introduction sources, but if you have access. Number 2 on the list is someone that Tim has co-invested with in the past. This could be maybe an angel who feeds him deals, maybe another VC who's done deals with in the past. There's a strong signal of trust there. Number 3 on the list is someone that Tim has invested in, like a portfolio company. There's also a strong signal of trust there as well. Tim spent the time doing the due diligence on that person, and obviously wrote a check to them, so it's a pretty strong signal. 4th on the list are what I call the professional connectors. These are often biz dev guys and gals at the big law firms or accounting firms. They tend to know everyone, right, in your local area. They know all the investors. The problem is they make a lot of introductions, so sometimes the signal's kind of weak. I leaned on both my attorney and my accountant, or the biz dev guy at KPMG, I think it was. And, they made about 10 introductions for me, and about 2 or 3 of them responded and led to a meeting. So it's a bit of a weaker signal. Where are we at on this list? 4th or 5th, wherever we're at. 5th on the list are people that Tim met at a conference 2 years ago, and they connected on LinkedIn, but it's not a real strong signal. If you have 0 connections, mutual connections, what do you do? Well, one pretty useful workaround is to look at Tim's portfolio companies, cold email a couple of the founders of those companies, and you just try and get a dialogue going with them. Like, hey, I see Tim invested in you. I've been following him. I love his articles on, Bitcoin. I'd love to hear how it's been working with him. You get a dialogue going with the founder. It's okay to ask for the introduction if they like what you're doing. Founders are usually pretty good about helping other founders. So that's a way to kind of leapfrog to, the third highest signal strength there. If you're not willing to do that work, there's the cold email approach. It's easy to find everyone's emails these days, right? There's tons of these email lookup tools. The problem with this is Tim is already getting 50 to 100 warm introductions a day from people he trusts. So your cold email, if it's even read, a lot of investors won't even read the cold emails. If it's read, it automatically has kind of a negative stigma to it. The stigma is you're either not networked enough to find an introduction, or you're too lazy to network your way into a warm introduction. So the cold email, I've seen startups try it. It's rarely effective. It's just not the way things are done. People hate to hear that because it's so easy to find people's emails, but really much better is to spend the legwork to try and find a warm introduction. And it's doable. I've seen startups do it. I've seen startups come here from even other countries, and spend some time kind of hustling their way into warm introductions. It is doable. Okay, moving on. Step number 4, we need a way of tracking all this. So let's say we have 100 to 150 investors still remaining on our list. We've figured out how to reach them as best we can. We're just about to start our fundraising in earnest. We need some way of tracking all the discussions, conversations, follow-on tasks you're just about to be having. Every time you have a meeting with an investor, it leads to 2 or 3 follow-up items. So you need a way of keeping track of it all. I used to build these beautiful spreadsheets for clients when I was a consultant. The problem with the spreadsheet is it quickly gets messy and bloated. You should see some of the spreadsheets that I worked with in the past. And at FounderSuite, we get a lot of people who are doing spreadsheet are now, importing the spreadsheet. So I'm going to just do a very, very quick product demo. Thanks for bearing with me. But this is our Kanban board. So it's the replacement of the spreadsheet. And you have the funnels here: new, contacted, pitched, due diligence, committed, or said no. And the little joke is, your job is to move all these cards across the board. If you move them all into committed, you win the game. If you move them all into no, you've lost the game. But this is how we think about fundraising, right? It's a funnel, and you're moving all the targets through your funnel as best you can. You can just drag and drop these cards. But, the CRM part of it is equally important beyond just the visual stuff. This is all the CRM stuff. Like you can, if you have a founder that's working with you, or maybe an advisor, you can assign them ownership of that investor. You can attach or add calls, meetings, tasks, whatever upcoming things you have to do, like to do a meeting with an investor, and then push it out to your calendar of choice. Attach files, what's the pitch deck or term sheet that you sent this guy. And then you can also connect your Gmail or BCC the system to all the email threads with Howard get pulled in here. And so really this becomes one central location for all notes, tasks, files, meetings, emails, everything else. There's the email sync. So, it becomes a system of record for your fundraising, which is really useful because we want to run a process. You hear people talk about that a lot, about running a process, and that just really means running a really efficient fundraise where things are moving along swiftly. If things are moving along swiftly, it's much easier to get momentum. You're going to hear me talk about momentum a lot. So much of fundraising is dependent on getting momentum going for your round. To get momentum going for a round, you need to run an efficient fundraise. To run an efficient fundraise, you need a CRM system or other ways to keep on top of it all. Okay. Thanks for sitting through my sales pitch. Whether you use CRM, FounderSuite, which I hope you at least try out, or some other approach, you need a tracking system. Step number 4 is getting all your documents ready. Now, I'm not going to go into this in detail because this is kind of a bigger topic, but it is assumed that before you go out fundraising, your deck is really good. You've given your pitch, 5 to 10 times to people who give you hard feedback, unvarnished feedback, and that you have, at a minimum, a budget, right? If you're asking for $1 million, You have a budget for how you're going to spend that and where it will get the company. Even better if you have a financial forecast showing what your business model could look like over time. So you need a pitch deck, you need some numbers, and a lot of times we'll put together a one-page or two kind of executive summary. Those are your documents. Even if you've done pitch sessions with your friends 5 or 6 times, your first couple meetings with investors are often kind of throwaway burners, we call them. So you might not pitch Sequoia, Kleiner, and Andreessen Horowitz in your first three meetings. You might go to a second or third tier fund for your first couple of meetings. Okay, I'm going to take a quick break to have a drink here, but now we're ready to rock and roll. Now we're ready to really start engaging with this target list of investors that we've put so much time into. So Jeff is one of my connectors, and actually he's real. I'll show you. He's over here. Where's Jeff? There's Jeff. I made a column called Connectors, and this is where I collect all my different connectors. Jeff is one of my connectors. This is a real email I sent to Jeff back when we were fundraising. Jeff, when I was doing my research on how to reach people on my target list, a lot of the roads all went through Jeff. Jeff is a really connected guy. And you tend to find that you have these power connectors. So Jeff is one of my power connectors. I put this email for him. Hey, Jeff, do you know any of these folks well enough to make a lightweight intro? And I list everyone who's on my target list that I want to get to know that Jeff knows. And Jeff can now just respond saying, I know Tom, I know Sean, I know Mamoon, I know Jessica, I don't know Wesley, I don't know Kyle. Noah's not investing anymore. So in 5 or 10 minutes, Jeff can respond and kind of give me the yes, no list. Now contrast this to that very first slide I showed you at the beginning of this talk. If I just went to Jeff and said, hey, Jeff, I'm raising money. Can you connect me to some investors? He'd have to think about his entire network. He's got like 800 people in his network that are investors. He'd have to think about that, process that, and maybe he'd come up with a couple names. But this is much more efficient. It's more respective of his time, too. I've done the research. I'm just asking him to kind of thumbs up, thumbs down, everyone. For everyone that Jeff gives me the thumbs up, I create a new email, clean email, new clean email, and it goes like this. Hey, Jeff, can you introduce me to Target? Then a little bit about, who we are, Founder Suite. And then at this point, we had a lead investor, and we had 2/3 of the round committed. So I put that in the subject line. The subject line is really important. Again, going back to the thing I mentioned a few minutes ago, these investors are getting 100 warm introductions a day. So you want to make sure they actually open up your email. Their inboxes are flooded. So your subject line is really important. We had 2/3 of the round committed. That's really exciting and sexy. If I didn't have, if I didn't have 2/3 of the round committed, I would put the most exciting, sexy part of my business in here, whether it's a growth metric, something else, doesn't even matter. It's just something that's a teaser. Okay. Good chatting with you. I'm raising a seed round, and this is what we do. Just a brief little kind of almost elevator pitch about what we do, investor management reporting platform, a link to our website, and then the ask. Could you introduce me to target investor? Here's the why. He's got a track record. And then I noticed that this guy went to the same college as my dad, so I put that in here just to customize and personalize this email. And then I include a link to our deck, which we have hosted online on Founder Suite. And it's a high-level deck. I don't include the whole deck. It's like a short version, high level of the deck. But I like to include this link in here because Clint, the target, can now look at this really quickly. If it's definitely not a fit for him, he can opt out up front, right? I'd rather do that than, getting the introduction, setting up a meeting, driving down to meet him, wasting a lot of time. I kind of use including a link to the deck as a way to pre-qualify these investors. Okay, so then Jeff can just hit, forward. Hey, Clint, do you want to take this intro? Send. Hey, Jennifer, do you want to take this intro to Nate? Send. Hey, Tom, do you want to take this intro to Nate? Send. I asked him to make like 6 or 7 introductions. I made it really, really easy for him because all he had to do was basically forward along the email and do the opt-in introduction approach. Making it really easy for your connectors, really, really important. Okay, so we're game on now, right? We've got all these introductions going out. And I include this slide kind of just as a bit of a humor. I'm sure many of you have seen HBO's Silicon Valley. This is from season 1. Richard's the CEO of Pied Piper. He's an introvert. He, all he wants to be doing is writing compression algorithms for his company, but he's got to get out there and meet with all these investors to raise money. All these investors are really smart. They went to Harvard and Stanford. They took a company public or had some other success. That's how they became an investor. And they have big egos, like this guy is great on the show, but very true. And these guys invest all day long, every day. This is their job. So they're professionals, right? They're experts at investment. Whereas Richard, this is the first time he's ever done this. So he's, an amateur, not even an amateur, total newbie. And that's typically how it is. So there's kind of this automatic asymmetry when you're out pitching investors. And it's really stressful. So you kind of have to just treat it as a game. And the key point is you have to kind of find your inner hustler, whether it comes naturally or not, right? It doesn't come naturally to Richard, but he finds his inner hustler. He gets out there and raises the money. So that's what you have to do. If you're not going to find your inner hustler, you're not going to raise money. And, you should just bootstrap instead. Okay, so some hustle tips. You've followed along this so far. You've got this approach. We want to be asking our connectors to be making the intros all about the same time. That's what I'd say by intros in parallel. And I call this the Blitzkrieg approach, right? We're getting a lot of things happening. And the reason we do it like that is because we want to get momentum going for a round. Investors, the old joke is investors can smell momentum. They can smell desperation. They can smell when a deal has gone stale. So, of course, you want to walk in smelling like momentum. Best way to smell like momentum is to be having a lot of meetings in a fairly condensed time frame. Every time you have a meeting with an investor, they always ask, so how's the round coming together? Right? That's their way of probing to see if this thing has any momentum. To the extent you can respond, we just started, but I've got 12 meetings this week, 14 meetings the next week. We're running a process here. And I'm feeling pretty good about it, right? That's signaling that other people are interested, right? You've got a lot of meetings, so that's key. All right, so about your pitch. You want to be constantly working on your pitch deck. When I was fundraising, I would go have, 2 or 3 meetings, come back at night, put my kids to bed, crack open a beer, and spend an hour revising my pitch deck, improving my pitch deck. Just tons of little stuff. But sometimes you can tell when you're in a pitch meeting and your marketing strategy slide is just confusing the hell out of people. You need to fix that. So, refine your pitch deck. By the end, we were on version number 42, and it was a masterpiece. It was like the best pitch deck ever because we just refined it constantly. Leveraging VCs off each other. We kind of talked about that a little bit. You're basically signaling that other investors are interested in this deal. As best you can, whether that interest is in meetings or, later on when you start to get offers, term sheets, things like that. That's really key. It's all about getting momentum. And then sending out a regular progress update is one of these lesser-known hacks that will set you apart from 99% of the other founders all chasing the same pool of money. And what I mean here is sending out a monthly update to everyone in your funnel who has not told you no. Everyone who is still a prospect or lead in your funnel, you should send them a monthly progress update. And this is doing 2 things, actually a couple of different things. It's showing you making progress, right? Because every progress update, ideally has some new growth or new deals, new product updates, whatever it is. You're making progress. You're also showing that you can communicate because every investor has put money into a founder who they then never hear from that founder for the next 9 months until the company is almost out of money. That happens all day long. Investors complain about this nonstop, that they don't hear from their portfolio companies enough. And so by sending a monthly update, you're showing you can make progress, and you're also showing you're a good communicator. and this sets you apart. So really, really important. And this is my last little product thing I'm just going to show you. We have a tool for this, of course, and I do my own updates using our tool, of course. Our approach is to make this as simple as possible, kind of the minimal viable update. So we've got these 6 sections, and we give you some prompts about what to write for each section, trying to make this as easy as possible. You can pull in a KPI table if you've got some metrics, pick which metrics you want to include. And then if you've maybe got product shots or a team shot, pull that in, add an image or 2 throughout the report. So it makes it, and then you can attach files too, like your pitch deck or something. So really, really quick and easy, 15 minutes or less to build an update. And I'll just show you what this looks like. It's a nice clean format. Investors really like this format because it looks very professional. They can navigate, your sections. And what it does is generate this URL that you can then send out to the investors in an email. And that allows you to track and see who's actually looking at your update, right? So I can see who's paying attention. So this is very useful too. So that's the investor update. Do this. It literally takes 15 minutes or less. Do it once a month to everyone in your funnel. You can also use this same tool to host your pitch deck. It's not quite as slick as some of the other alternatives out there, but it's nice. It's simple. You have your pitch deck up here, and then I can track and see who's looking at my pitch deck, right? So, all right, that is the end of my product placements. Thank you for paying attention. Last point here is trying to, as best you can, attacking your fundraise as like a full-time job. I know this is like almost impossible for most founders, but if you have a co-founder that you can give some of your job to, so you can really focus on fundraising as much as you can. It's really hard to get momentum going if you're just kind of putting in a couple hours a week on your round, right? Whereas it's much more feasible to get momentum going if you're really hustling full-time. And it can take a couple months, so this is not easy to do. And it's really, really stressful. When I was fundraising, I would wake up, I'm not even making this up, I would wake up at like 3 a.m., 4 nights out of the week in a cold sweat, worried that the round was falling apart. I thought I was getting an ulcer. I had my dad write me a prescription for ulcer medicine. I ended up going to Walgreens with this prescription, and it was like $200. So I didn't even get the prescription, and it turned out I wasn't getting an ulcer, but I actually thought I was. The only time in my life that I thought I was getting an ulcer was when I was raising money. It's stressful. That's the way it is. You're not alone. You can always ping me if you're about to jump off a ledge. Don't do that. Okay, a few more things here. A few more hacks. We're getting close to the end here. Take your target's email and put them into retargeting ads. So we did a little of this. We ran some Facebook retargeting ads. One of my angel investors, who I just saw the other day, he did tell me, he's like, every time I log into Facebook, I see Founder Suite logo. So maybe it had, some psychological effect. I don't know how really effective it was, but he did write a check for $70,000. So that was probably worth the couple $100 we spent. And what we're doing by doing retargeting ads is staying top of mind with these investors. So let's switch into investors, day in the life of investors. They're getting 50 to 100 introductions a day. They're meeting with, 5 companies a day, 25 companies a week. So the volume of companies coming through their inbox and through their doors is huge. Most seed funds will do like 10 or 12 deals a year, and they meet with like 1,000 to 2,000, right? So there's this huge amount of noise coming through investors' minds. And so by doing retargeting ads, by sending a regular monthly update, and if you have a PR firm or if you can get some PR, this is all really useful to just stay top of mind with these investors who are getting so much stuff thrown at them. Retargeting, PR, your monthly update. Okay. Point number 2 here, we kind of already talked about this, putting your deck up online using Founder Suite or Google Slides, whatever it may be. This allows you to track and see who's looking at your stuff. It also allows you to keep your deck fresh. So, I would send out that one URL, right? Like, here's the URL that I would be sending out, but I would be revising these slides constantly throughout the fundraise. So even if I sent this URL to an investor, 3 weeks ago, he comes back and looks at it, my pitch deck has evolved since then because I'm improving those slides constantly. All right, number 3 here. This was suggested by a user, basically using Facebook to map your connections to investors. The premise is that, for example, I've got 3,000 LinkedIn connections, but only like 300 Facebook friends. So if there's a mutual connection, it's maybe a stronger signal. AngelList. AngelList is an interesting platform. They are really focused on syndicates. Oh, no, shit. Sorry, Brad. Uh-oh. Sorry, guys. I don't know what happened there. Okay. You guys still there? Everyone good? I think I temporarily let someone else present. Okay, I'm going to keep going. I hope you can hear me and see my screen. But AngelList is all about syndicates these days. Oh, thanks, Bruce. So syndicates are basically an angel investor who has found a small army of backers to co-invest with them, right? So they can collectively write a larger check, usually like $200K is a typical kind of syndicate size. So it could be another interesting avenue, another deal, another place to raise money. The challenge with syndicates, though, is they typically invest if you've already got half or 2/3. No problem, Brad. Syndicates typically invest if you already have like 2/3 of the round committed, right? So they're not really good about sourcing a round or starting your round. They're really good for filling out your round. Angel groups are kind of interesting. There's like 1,400 angel groups. If you go to or just Google Angel Capital Association, they have a directory of angel groups. Here in the Bay Area, there's at least like 6 or 7 in different angel groups, probably more than that. Sandhill Angels, Golden Gate Angels, so on and so forth. The advantage is you can get in front of 60 angel investors all in one shot. The disadvantage is it usually takes a long time. You apply to these things. There's a screening committee, usually another screening committee, so on and so forth. So angel groups can take a while. I wouldn't rely on them as my fundraising, but it's okay to pursue that in parallel. And then crowdfunding. Crowdfunding is interesting. I think crowdfunding has a good future. I think currently a lot of these equity crowdfunding sites, there's a lot of kind of junky stuff on them if you kind of dig into the deals. And I know a lot of founders, maybe it's a weird data set, because we get a lot of people on Founder Suite who tried to go on a certain site. I'm not going to name names, but they tried to go on the site. Nothing really happened. And now they're trying to kind of run a traditional fundraise. So I think crowdfunding is interesting. I think some of these vertical crowdfunding sites, like if you're in video games, there's one called Fig, or Circle Up is a consumer products one. I think those are interesting, but I think crowdfunding will take some time to really develop. This last point here is doing an initial close. So what I mean by that, it's back to that talking about scarcity and fear of missing out. The investors are pretty powerful. If you've got $300K in, say, friends and family commitments, and you go out saying you're raising a $500,000 round, your round already looks, 2/3 of the way full. And then as it starts to fill up to that $500K, you raise the amount you're raising to $750,000 or to $1 million, and so your round is always kind of over half full. That's much more kind of optically appealing than if you're raising a $1.2 million round and you've got $300K in commitments. It doesn't look like there's scarcity. Let's see. Viewer number 6 had a quick question. What do you do different for your online pitch deck and the more detailed one? I like that. You know what? Let's save this question for the Q&A at the end, but I like that question, viewer number 6. So we're almost at the end here. Let's tackle that too. Okay. Closing the round. Last slide here, or second to last slide. So every time you have a pitch meeting, closing your round is hard, right? You get all these meetings going. Now it's our job to kind of switch into closer mode. Every time you have a pitch meeting, you should not walk out of there. Just make this a habit that you don't end the pitch meeting until you actually ask the investor what their interest level is. And if their response includes a next step, like let's have you come in, meet my partner next week, that's a really strong buying signal. So just always ask for that. And then also don't walk out of that pitch meeting or don't end the Skype call until you've made them pitch you a little bit. So something like, hey, I've really enjoyed telling you about FounderSuite and our vision. I would love to hear how you help your portfolio companies, and I would love to hear, how you would help FounderSuite in particular. Make them pitch you a little bit. And the reason this is so powerful is that every investor who's been doing it for a while has lost out on a competitive deal. In other words, they tried to get into a deal that had more investors interested in, they could allow into the deal, and they were bumped out, right? And so by making them pitch you a little bit, you're signaling that, getting into your deal, into your round, isn't a sure thing, that they might have to hustle a little bit. Taps into that, really powerful fear of missing out that investors have because they've lost out on deals in the past. So just get into the habit of doing these two things. I think it'll improve your fundraising quite a bit. Let's see, point number 3 here. It takes a couple meetings before people tend to commit, usually at least 3 or 4. If you're on meeting number 6 or 7 with someone, they might be a tire kicker. They probably are a tire kicker. I would, not have more than 6 meetings, I think, if you can get away with it. And, also on the timing, it tends to take about 3 to 6 months. So if you raise money in 2 months, you're really amazing, and I'd love to hear what you did. But if you're still raising money 6 or 7 months from now without really any strong buying signals, something might be kind of wrong with your pitch or your deal. And of course, so much of fundraising is about getting that first term sheet or that first commitment. Once you get the first, term sheet or first lead investor commitment, then you can go around to everyone else in your funnel and use that as a catalyst to get them to commit or say no. Let's see, follow up frequently. It can be very hard to get an actual no. You'll have this great pitch meeting, and then you just never, you think you've nailed it, right? You think you've just landed the deal, and then you never hear from that investor again. My rule of thumb is I send like 2 or 3 follow-up emails. If they still haven't responded, I just, assume it's a no. I actually have a column I'm just going to show you because it's kind of funny. I actually have a column in my FounderSuite board that I added. This is not a default column, called no response. So I have the hard no. I have the no response. These are for investors that just stop responding, that ghost you. And then I have a revisit for Series A. These are people who say, I like what you're doing, but you're a little too early for us. So I move them in here. Then I have a list ready when I'm, at that stage. So investors do this all the time. They just stop responding to you. And partly it's, if they say no, that deal is dead to them. If they don't actually say no, then and your deal suddenly heats up, it's sort of like optionality. So it's really common behavior, but very frustrating for the founders. This point here, Paul Graham Handshake Deal Protocol. What this means is, Paul Graham is with Y Combinator. What this means is when someone, you're out at a meeting with someone, they say, I like what you're doing, put me down for 50. You go back to your computer, send them an email saying, great meeting with you. I just want to confirm you're in for 50K. Please respond. And if they write back saying, yes, I'm in for 50, they've closed the loop, right? There's a kind of a chain there. If they don't do that, they're still just a prospect. And then last but not least, most important on this slide is don't let up until those wires actually cross into your bank account. I've seen many, many startup founders who start working on fundraising. It's time consuming. It's awful. It's stressful. You're getting rejected constantly. And they kind of start to get pulled back into their business, their product, their customer stuff. And they sort of take the momentum off the fundraise, and then like one of the investors drops out, another one drops out, and the whole round collapses. and the company runs out of money. I've seen that play out so many times, and it's a terrible tragedy when it happens. So the key point is, if you're going to raise money, keep your foot on the gas pedal all the way. You can't stop until those wires actually cross the bank, drive it over the finish line. Here's the money shot. And then, kind of last parting thoughts here. It's just the beginning. You raise money, have a celebratory dinner with your team, your advisors, whoever else helped you along the way. If you're using Founder Suite and you raise money, please let us know. It would be awesome to hear your success story. But then Monday morning, get up and get back to work, because you raised maybe $1 million that buys you 12 months of runway. That actually means you need to start fundraising again 6 months from now. So, just the start. The joke here, Reid Hoffman said it, fundraising or startups are like jumping off the cliff and assembling the airplane on the way down, and that's very true. You've got some money in the bank now, but you've got to get lift off. And then very last slide, and we'll do Q&A. I'll send you guys this pitch deck or the slide deck. We have some deals for new customers, and then we also have this Funding Hacks Facebook group. It's not super active, but people are kind of trading different stuff. There's some chatter about ICOs and different pitch decks, things like that. So thanks for listening. Let's tackle a couple of questions here. So viewer number 6, what do you do different for your online pitch deck and the more detailed one you send to investors via email? Okay, I'm going to take that one first. So I actually I try not to send a deck by email. I know a lot of times they ask for one. It doesn't mean you have to give them what you have. Once you send a deck by email as an attachment, it's out of your hands. It can wind up in competitors' hands, and it's also out of date. So it's out of date the moment you send it, right? Versus an online pitch deck, you can continually update and improve. So I almost never send a deck as an attachment if I can get away with it. And then, do you have any good examples you can send for reference? Yeah, I'm happy to. Just shoot me an email. Actually, I think we have some pitch deck templates in Founder Suite, and I have some other. There's a couple online sites I can point you to that have like collections of pitch decks from Airbnb's first pitch deck and Uber's first pitch deck, stuff like that. So tons of them out there. Just email me and I'll shoot that to you. Brad, no problem. Let's see. Does anyone else have questions? If you can type into here. I guess we could, I think we can use this for Q&A. Does anyone have any comments, questions? Are you guys more or less motivated to go raise money now? Sometimes I give this talk and I think it scares off 25% of the audience, which is probably good. Brad, yeah, this set of slides that you're talking about, I will send the set of slides out. And then if you, actually I'll try and find that link to the page with all the other pitch decks of other companies. I'll try to include that in the same email. Thanks, Brad. Okay, all right, a couple questions here. Viewer number 7, do you think it's a good idea to use this for an ICO fundraise? ICOs are such a Wild West thing right now. I've been studying it. I can't claim to be an expert on it. It seems to work best, if your product is related to tokens, blockchain. I think just for your average run-of-the-mill startup, doing an ICO doesn't make sense because you're creating this currency of tokens. Like, what value are those tokens going to have if you're not in the blockchain space? So, that's one thing about it. It seems to work best if you're in the blockchain space. It seems to work best if you have a really large audience already, right? A lot of these ICOs that do really well already had like a bunch of fans, backers people involved that obviously came in on the deal. And then I think the other thing to be kind of concerned about is it's going to get regulated. I have no doubt that the SEC is going to come in and regulate the ICO market. And so that could have some pretty serious, effects on that. So it's really exciting when you hear, a startup raises $100 million in 12 minutes or something like that. That's a pretty rare case. It's not like the average typical startup can just go do an ICO and have success with that. So, and to answer your other question, is there a list of ICO investors? No, not that I know of. If there is, I'd love it if someone told me about that. Good question. View number 7, join this Facebook group, Funding Hacks, because there's some good chatter in there about ICOs. There's some good threads. Okay, anyone else have a question about anything fundraising, pitch related, anything else? Going once, going twice? If not, that's okay. We can end this here right on time. And if you do think of a question later, you can always email me. I'll send this deck around. I'll send the link to the pitch decks around. I'll send the link to the recording. You guys have a great weekend. Play around with Founder Suite, and I hope to see you around. Thank you.